It has been asked that Gary Wagner help guide you with the help of his Fibonacci chart, so we delivered. We have him up next. As always, Gary Wagner joins us from sunny Hawaii. Gary, thanks for being with us.
My pleasure as always.
Gary, we've just been flooded with emails from viewers who are asking for your help and the help of your charts to help guide them through this period of where they're not really seeing a lot of action in the gold front. What's your sentiment right now?
I mean, there's no question. We have been in critical areas where we needed to hold support, but more importantly, we've been in a market that hasn't been trending sharply one way or the other, and it's been kind of range bound. Right now, the characteristic has been a descending top, but we're also getting an ascending bottom. So we're going back into a compression, but it has been a tricky market to trade. There can be no doubt about that. I think that although Fibonacci and Elliott wave technical analysis will shed a lot of light, we need to be open and listen to what the fundamentals are and if anything's changing.
Gary, do you think that the sentiment is still bullish for gold?
Well, especially with the jobs report last week, what we saw was an increase in unemployment. We increased the jobs, I think, to about 150,000 plus, but realize it takes about 250,000 just to stay even. So there's less people working, there's more people unemployed, and that puts pressure on the Fed to continue the stimulus, and they're putting in $85 billion a month. So to me, that spells a overall bullish outlook on gold.
Right, Gary, you brought up jobs numbers, and last week was a big week in terms of the FOMC, the GDP, and I guess my question to you is, do you look at that data? Is it relevant for you, and are you concerned by any of the numbers that you've seen recently?
Well, the first part of it is I'm absolutely focused on different pieces of fundamental data that come out in the market, because as a technician, the numbers simply allow us to distill that information maybe into a more digestible format, but it is the news that moves the market, not the technicals that move the market. So I'm absolutely concerned, and I do watch that. Now, in terms of the numbers, the fact that the economy is not really taking off, and I wonder about that for one simple reason. Although the unemployment rate went up, we had last week a stock market that broke 14,000. Corporations are doing very well. I just don't think they're employing as many people. But yes, there's definitely signs in the air that signal a continuation of more of this sluggish global economy.
Gary, also, do you look at the correlation between 10-year bond yields and gold because both are seen as a safety play?
Absolutely, absolutely. However, I don't really have a simple correlation where if bonds are here, gold is here. I look at the correlations, of course, between any of the interest-based instruments as well as the currencies, because it's really the currencies that tend to be more of a dynamic force on the precious metals markets.
Gary, so I think your insert will be perfect today, especially for viewers who feel that gold prices have stalled, and basically how do you play it? So what have you brought for us?
Well, really what we're going to do is we're going to take a look at technical analysis, Elliott wave and Fibonacci specifically, and look to make sense of the current market scenario.
And Gary, just before we get to your insert, what level is key for you for gold right now? What numbers are you looking at?
Well, there's a couple of very critical numbers. On the support side, I've got a band between 1520 and about 1534. If you recall, that's where we had the major breakout when it spiked back to 1700. That's the other key number. We were trading with a top of 1800, but these last couple of tops have stalled at 17. So we really need to make it over that century mark. That's a huge psychological barrier right now.
On that note, Gary, let's get to it.
There's absolutely no doubt that trading the gold market is always tricky, always requires a lot of skill. But the one thing that we can say right now within the market is it is a much more difficult read than it has been in the past. And what do I mean by that? We're looking at a long-term chart. It is a daily chart continuous contract of COMEX gold. And this area back here, of course, is 2008, hits 1,000 and then corrects to go back to about 700. From that point on, as you can see quite easily, is that it traded really within a channel, and it was an upward channel at that. And you can see that the market literally would go from the top to the bottom of the channel as it traded throughout the range, and in most occasions going to higher highs. And one of the ways to really look at those higher highs, of course, is I put in a high and then a horizontal line in these three spots so that we can really, in terms of just eyeing the chart itself, we can really see when it goes and breaks the previous highs and goes to a new high, such as right here. And as you can see, the market finds real resistance again in this area, but then is able to move up, break through that, and get to a new top right here. This new top being at around 1450, and so on. However, we had a fundamental change in the way the market traded as soon as it literally went parabolic. And what I mean by that is as follows. Once the market hit this record top at 1920, we really had a new game or a new set of rules that we had to follow, because now what we saw is the market had a defined low, as you can see with this triple bottom here. And in terms of the highs, once it came back down here and moved back up, we had highs just at around $1,800 per ounce. So the real characteristics of this marketplace, the first thing that we notice, of course, is that rather than going to higher highs as we saw throughout 2008, 2009, up to about, call it the mid of 2011, when we saw this rise up here, now we started to trade within a defined range. And that defined range was above 1,500, just above 1,500, and just right around 1,800 per ounce. Now, although the basic parameters within the gold market had changed, one thing became evident as we looked at these charts over and over, and that is that there were characteristics that were now evident. They weren't evident before in the marketplace, but as these prices unfolded, we started to see something repeat itself. And what I'm talking about is the pennant formation, or the way the market had corrected here. As you can see, once it hit 1900, we had a series of lower highs. We really had what we call a flat bottom. So it's a descending top and a flat bottom. From there, we had this tremendous breakout, but the breakout stalled at about 1800 again. Once again, the market went into a very similar pattern. In other words, here we get descending tops, but we're also getting ascending bottom. So we're getting this triangle breakout. Now, when we take a look historically, you can see that every time this market had descending tops, we had a pretty strong breakout that would follow. Again here. Then we had a breakout to new highs. Now, what that means to me is that if history repeats itself, and if we see a similar scenario in our current market, we should see some sort of a compression triangle as we're seeing here, and that should be followed by some sort of breakout as the market really builds energy. Because the whole idea behind a compression triangle is that as that range narrows and you get a series of lower highs and higher lows, the compression itself builds energy, and when it does break through the upper resistance or lower support, you get a sizable move in the market. And so when I take a look at what we are witnessing now and my current observations of a wave count, I arrive at the following conclusion. First, our current wave count. If our assumption is correct, this was the top or the conclusion of a major third. This corrective period here was our major fourth, and of course it's comprised of intermediate and subcounts. We're not going to go into that, but I also believe that we after that, following these lows that we hit, this triple bottom and this breakout, I believe that we began our major fifth, and we've just really begun the major fifth. Now, as we are in the throes or the beginnings of this major fifth, we're putting together a couple of different models in the way we believe that market trading activity could in fact unfold. What we believe so far is as follows. We truly believe that we saw a strong impulse wave, and that strong impulse wave really took us just from this triple bottom, these lows at around 1565, I believe, and took us up just at about 1800. Let's go ahead and draw that line in here. And as you can see, we did reach just about the $1,800 level. Now, there could be no doubt we have, again, a series of descending tops, and we are now getting some ascending bottoms here. And so that's what's leading us to believe that our first belief, which was that what we're witnessing was a simple A, B, C correction, might in fact be a model that we have to put on the sidelines, because following an ABC correction, you usually will get the market taking off as it began to, but it certainly wouldn't come back down and once again come close to testing the bottom. That to me is more indicative, or it seems more logical, that we're going to go into some sort of a compression triangle once again. Now, if we do go into a compression triangle, really what the characteristics will be is a tightening of range, meaning lower highs, higher lows, and as that market goes to the apex itself, we should get a release of energy and a sizable breakout. So traders, really what we want to be looking at in the marketplace itself within this compression triangle is if the highs and lows stay within this parameter until we get a break somewhere near the apex of the market. Elliott wave, Fibonacci, and trend analysis. We want to thank you, our Kitco viewers, for your continued support. And as you know, for those who want to look a little bit deeper into the topic that we have been discussing on today's show, we will offer you some bonus content. I'm putting up an image of the first page of our website, thegoldforecast.com, and that C, I'm going to circle it now, is what you will do to go to the bonus content to view it. But what I'm also going to offer is a special introductory price for those that want to dive even a little deeper into the analysis that we offer, and give you a special introductory price for the first month to try the service and to see if it's something right for you. To that end, you'll need to enter the bonus code, and you can see the bonus code appearing on screen now. It is Kitco, not too hard to guess. And when you enter that on the sign-up page, it will allow you to get your first month of the Gold Forecast, which is our daily newsletter, for a 75% reduction in price. Again, Fibonacci, Elliott wave, and trend analysis. Bye-bye.
Gary, as always, so educational, and you know I have to ask, is there more to come?
There's always more in store, absolutely.
We look forward to it, Gary. Thank you for being with me this week.
My pleasure as always.
And thanks for watching this edition of Chart This. You can email me any comments or questions at newsfeedback@kitco.com, or join the conversation on Twitter at Daniela Cambone. Thanks for watching.